In less than half a day, the bell rings, and the weekend already rewired the board. While most people unplug, I map every market that keeps trading when the big venues go dark, so Monday doesn't ambush you. Today, silver, gold, crude, and a conflict that's actively reshaping energy pricing in real time. And I'll show you what the always-on markets whispered while traditional futures were closed. Quick note, if you're a guru quietly mirroring these weekend checks, watching tokenized metals, citing vault stats, tossing around the same technical jargon, yes, I see you. Consider it free education, but at least be honest about where the framework came from. Drop one word, wines, in the comments, so I know the real ones are tracking. Now, numbers first, opinions last. Let's start with silver. Western spot is around $84. Meanwhile, Shanghai is valuing real, deliverable metal near $96. That S roughly at $12, spread between paper pricing in the West and what buyers in the East are paying for physical. That gap isn't trivia, it's a stress test. Why would anyone pay $12 more unless they cared about the form of silver, not the symbol? Now look at inventory. Comex total silver stocks sit near 349 million ounces as of Thursday, and one session alone saw about 2.2 million ounces disappear. That makes 9 straight weeks of net drawdowns. The weekly drain was roughly 8.4 million ounces, about 262 metric tons in 7 days. At the same time, London's LBMA silver holdings slipped about 2.4% in February, now near 870 million ounces. 2 major Western vault systems losing metal simultaneously, while the East pays up for bars. 3 separate signals pointing the same way. That $12 premium is the message, not the noise. Paper can shout, metal just leaves. And if you've been watching the recent sequence session by session, you've seen how relentless these steps can look when the underlying plumbing tightens. The point isn't the exact ticks, it's the directionality. You can nudge futures with leverage. You can't fake an emptying warehouse for long. That's mechanics, not mood. Now gold. Western spot is roughly 5,171. Tokenized gold over the weekend printed around 5,177, basically flat versus Friday. Tokenized silver was about 85.4, also close to where paper settled. So heading into the open, weekend metals pricing is not screaming gap up tonight. But don't confuse flat with safe, because the weekend itself wasn't calm. Reports indicate U.S. and Israeli strikes hit significant Iranian oil infrastructure. Oil reportedly spilled into streets, moved through drainage, ignited, and turned highways into corridors of fire. Residents woke to thick, dark skies and air that sounded like it hurt to breathe. And Iraq's production? Estimates suggest a collapse near 60% as the conflict disrupts tanker movement. So while CME sleeps, decentralized perpetual markets keep printing a price. On one of those venues, U.S. crude traded near $115 after tagging highs around $126. Brent hovered around $97 there as well. Are those prices a promise? No, but they're a signal you ignore at your own risk. Now zoom out. Reports also say special operations planning could aim at seizing Iran's enriched uranium stockpile. Hundreds of kilograms, potentially enough material for multiple weapons. If that goes from rumor to operation, you're no longer talking about limited anything. You're talking about boots inside Iranian territory. How long does a market take to price a longer war when it's still pretending it's a headline cycle? Let me be precise. Weekend oil prints are directional clues, not a trade command. Markets love punishing the crowded, obvious move, and right now, oil up is the loudest consensus on the planet. If you hit buttons at the first minute of the open, that's your decision, not mine. This is macro education, financial conflict mapping, not a signal room. Still, notice the divergence. Mainstream coverage tries to sell de-escalation. Energy pricing isn't buying that story, it's pricing supply risk. And the choke point remains the Strait of Hormuz. Roughly 1/5 of global oil flows through that narrow passage. If that artery gets pinched, the whole body feels it. Then another detail dropped. A desalination facility in Bahrain was reportedly struck. That matters beyond a headline because the Gulf relies on desalination for survival. Kuwait, around 90% of its water. Qatar, almost entirely. UAE and Saudi, both heavily dependent. When water infrastructure becomes a target, you're no longer in a military-only conflict. You're in infrastructure warfare. Iran's foreign minister warned that critical infrastructure attacks would have severe consequences. Then a water site is hit. The war is moving from bases to systems, energy, shipping, water, logistics. When those systems become targets at the same time, oil stops trading like a commodity and starts trading like a geopolitical insurance policy. Saudi Aramco stock jumped hard Sunday, the biggest move since spring 2023. But the equity move is the surface. Underneath, reports of drone attacks on fields with limited damage, and the Ras Tanura refinery, Saudi's largest, previously forced to pause after recent strikes. Aramco is rerouting exports through Red Sea facilities to reduce dependence on Hormuz, with multiple supertankers already loaded, and this month on pace for records. They also raised April pricing for Asian customers by the most since mid-2022, with earnings on March 10th. South Korea is even considering an oil price cap, something it hasn't on IT weighed seriously since the late 1990s. If your brain is flashing back to the 1970s, you're not crazy. Supply shock, inflation, policy tools that feel blunt, and pressure on currency credibility. And if you know what precious metals did in that kind of decade, you understand why this backdrop matters. There's also strategy here. Higher energy costs hammer manufacturing, heavy importers more than producers. Bigger import bills compress trade surpluses, shrink export margins. And because oil is dollar-priced, importing nations must first source dollars. That's not a conspiracy. It's the layout of the system. Now ask, what asset benefits when sovereign balance sheets need reinforcement in an over-levered world? Gold. Energy, metals, and geopolitics aren't separate lanes right now. They're one intersection. Public statements reflect it. That isn't a calming signal. That's a mobilization signal. War economy language. Spending confirms it. Roughly $6 billion spent in week one alone, with around $4 billion on munitions, especially interceptors. That's not just intensity, that's duration math. Iran reportedly selected a new supreme leader and will announce soon. Israel responded that any new leadership would be targeted. Iran says it's ready for full-scale war. Do those sound like off-ramps or deeper entrenchment? China also stepped forward with formal messaging. Foreign Minister Wang Yi, speaking at a major political session, said China is ready to help restore stability and peace. That's Beijing, signaling interest in the region's future architecture, right when the current architecture is cracking. Iran is a key node for Belt and Road logistics, and most Gulf oil flows east. China's posture is positioning, not poetry. Now risk assets, because capital flows tell you what people actually believe. Crypto lost around $190 billion in 3 days. Bitcoin down over 8%, Ethereum near 10%. That stacks on top of Friday's damage. US and European indexes closed red, and about $900 billion got erased from US equities in a single session. Risk is repricing a longer conflict across multiple arenas. And here's a quieter stress point, private credit. BlackRock reportedly restricted withdrawals from a $26 billion corporate lending fund after about $1.2 billion in redemption requests in one quarter. They capped exits at 5% and deferred the rest. Blackstone's massive fund saw record withdrawal requests the same week and injected roughly $400 million of its own money to meet redemptions. Blue Owl saw investors pull about 15.4% from one fund in January, forcing $1.4 billion in loan sales to pay out, and then permanently ended normal redemptions in that vehicle. 3 large alternative managers, same window, same theme. Liquidity gates. Howard Marks wrote that cycles turn when complacency peaks and risks feel distant. 18 months ago, few people were worried about liquidity mismatch. Now doors are getting partially shut. The cycle doesn't send invitations. It just changes the rules mid-game. Back to gold because the mainstream framing is missing the signal. One of the largest gold ETFs saw a huge weekly outflow, around $4.2 billion, near all-time high price levels. That means paper sellers hit the tape hard. But we always do both sides. Paper still drives short-term discovery. A ceasefire rumor, a sudden dollar spike, or coordinated algo selling can slam silver quickly. Tight physical conditions won't stop a stop hunt. The $115 weekend crude print is a clue, not a guarantee for Monday. And the calendar this week is packed. CPI Wednesday, then GDP, PCE, and JOLTS on Friday. Any one of those releases can hand paper traders the excuse they need to whip price around. Volatility doesn't care about your thesis. So here's the composite picture into the open. 9 consecutive weeks of COMEX drawdowns. London silver down in February. Silver ended Friday around 84.6 and struggled to hold above 85 repeatedly, even with a softer dollar, worth watching. Gold closed near 5,170s and is still tracking toward near-term objectives we discussed. First around 5,081, then the psychological $5,200 area. Gold showed more relative strength than silver Friday, and that ratio matters. For invalidation, keep an eye on Friday morning lows around 8 a.m. Eastern as a near-term line in the sand for both metals. Watch the futures open tonight at 6 p.m. Eastern. Track COMEX inventory updates through the week, and watch CPI. Inflation data landing into an active energy shock is not just a number, it's a narrative pivot. Verify everything yourself. COMEX reports are public and updated frequently. LBMA releases monthly stats. The fund-gating items are in major reporting and filings. People who read primary sources don't need to borrow conviction from influencers. Here's the question I want you to hold before the open. Tokenized gold and silver were basically flat, while weakened crude spiked, and the region is literally burning. So what is the metals market already discounting that the rest of the world hasn't digested yet? Or what lesson is it about to learn the hard way? Calm prices can hide loud problems. If this helped you think clearer, hit like and subscribe to Vantage Economics so you don't miss the Monday setup. I'll keep tracking the signals while the big venues sleep.